Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome a special guest, and that is Bron, who's the Senior Precious Metals Analyst at Pallion, and he did a fantastic presentation when I was at the Gold and Alternate Investment Conference in Sydney recently, and I wanted to grab you on. We're going to talk about the gold to silver ratio, his thoughts on precious metals, and he's diving into the crypto space as well, so I'm looking forward to discussing the overlap there. So Bron, I think you must have a fascinating background with all those things that you're now interested in, so how did you get into all of this?
I've been in precious metals since about mid-90s. So I'm at various companies, and now with Pallion, which is sort of a Sydney-based group that covers refining, bars, and also jewellery manufacturing as well. So they're right across the whole value chain. I've been sitting in gold for quite a while, and obviously in gold you get into monetary issues. And it's really sort of staying in touch with the sort of monetary aspects of gold and looking on sort of Austrian economist forums. Actually, Mises.org, a discussion forum, is where I first came across Bitcoin, because there was this huge debate between the early crypto guys on that forum and the Austrian economists, and they were debating the fact whether Bitcoin could actually have any value, because at that time it was like 1 or 2 cents or something, right?
Yeah.
And no, I did not buy any because it was really hard. it was almost, you could probably just at that point, I think, mine it yourself on a PC.
Yep.
But otherwise it was impossible to buy, hand to hand or even online. But yeah, there was a big debate there, and that got me very interested in it because it really was a challenge to what is money. And the Austrian economists on that forum were very dismissive of it. They've been proven wrong, obviously, subsequently.
And what was their main thinking? Is that the Austrian school that it needs to be a good store of value or method of payment first, or what was their debate in those early days?
The debate was actually around this thing called, Mises had a theory called the regression theorem, and that his theory was that gold became money because it was first useful as a barter good.
Yes.
So gold was like sought after because of jewelry and its attributes, and it was used in barter. And because it was the most sort of, all those things that you mentioned, like it didn't tarnish, it was everlasting, it had a very high density to its value, it became the most tradable bartered good, and by becoming the sort of most tradable one, it therefore stepped into money.
Yeah.
And so the Austrians who sort of believed in that theory were debating the crypto guys who were saying, hey, there's this Bitcoin thing, and they were like, it's impossible for Bitcoin to pull itself up by the bootstraps from zero value, because they said it doesn't have any use value in their mind, right?
Yeah.
And so it was a very interesting debate, because that was the first sort of part that fascinated me, was the fact that Bitcoin really does get people to ask the question, well, what is money? Can it be money? What's value? What makes something valuable? And so obviously the Austrians were wrong, because, it's now thousands of dollars, not 1 cent.
Yes.
And I think their mistake was it's digital and it's numbers and it's mathematics. But what they misunderstood was that it had a value, because if you want to go right to the beginning, it had a purely collectability or novelty value to early cryptographers.
Yes.
And then it built on that to create, value around people that wanted a non-government form of money and all of those other attributes. And so I think that was probably a lot of early days for Bitcoin, with people not really understanding what the use was, because they're focused on the fact that something has to be physical.
Yeah.
And they couldn't get their head around it.
I think in those early days, it was so hard to conceptualize what it could become. And we forget that even in 2008, we didn't really have such viral network effects of the YouTubes and Facebooks and even payment systems like the PayPals of the world and whatnot. None of that had really taken off yet. So there wasn't any Bitcoin wallets or anything like that early. No. So how could you pay someone else? And we joke about the, 30,000 Bitcoins for a pizza, but that really did make that first bootstrap, as you say, to give it some sort of value, and then the scarcity. And I just love how it was the Keynesians and the Austrians debating, and then it was the cypherpunks. As you say, the Mises Institute has got some fantastic videos out there in the very early years about what is money and gold and Bitcoin, and it does get people asking these really tough questions that they otherwise wouldn't think of at all. So how has it maybe evolved from then till now in your eyes?
Look, I have been quite fascinated by it, and like from my own point of view, I've been quite interested in crypto just from a privacy point of view. So I've got all my files. Anything that's decently private is all under TrueCrypt or VeriCrypt now. Folders and everything. So I was into that stuff from early at a sort of superficial level. But I think what's interesting is that I think the whole sort of crypto space is really finding its way through and developing structures that do exist in existing financial markets. And I did see on the Financial Times, they did once sort of say, look, what's happening in crypto and cryptocurrencies is that people are sort of rediscovering 300 years worth of financial banking rules and regulations. Now, and the reason, and I mean, I should preface that because there's a reason why, like a lot of things that I think people misunderstand in crypto about finance is that they go, oh, look at all these regulations and all these rules and all these structures and all these middlemen. What are they there for? Let's all break it out. Now, I think there's a valid point to say that a lot of the stuff that we deal with in financial markets is probably not necessary, and it is too much intrusion by government and unnecessary. But there are also structures in place that come evolved purely as a result of a totally free market. Because finance, a lot of things like clearinghouses, for example, were put in place by banks to help them settle between themselves, and we're not central banks, and we're not, it was a free market development.
Yeah.
So a lot of these structures are put in place to make the transfer of value and money operate efficiently, and so there are good reasons for that. But other things have probably been put in, and things have been put in place, either self-regulations or otherwise, to stop a lot of scams that the market dealt with. But then other things that come on top of that have become probably unnecessary. Yeah. So it's very hard. You don't want to throw the baby out with the bathwater and say, let's get rid of everything. Yeah. There's a reason why certain things are in place. And so what's interesting about crypto and cryptocurrencies is that as they evolve, we see scams in there, and then they're evolving structures to try and get around that. And so the question is, it may end up the Financial Times person who wrote this is a bit dismissive in the sense that crypto is going to end up with effectively the same thing that the banking system's got. And I'm not sure that's the case, because I think it will develop the necessary structures, but not the structures that have been imposed upon by governments, and purely because there are rent seekers and crony capitalists that want to have monopoly power and all of that sort of stuff. So it'll be interesting to see how it develops, and it may end up moving down a path which provides the control and structure and legitimacy, but without onerous and excessive sort of control.
Yeah, I kind of think of it like in the West, if they really clamp down on it, then they're going to add the friction. And if we have these developing nations that have got hyperinflating currencies, or basically got nothing to lose, or they want the innovation and the money there, if they create all these apps and ways for people to start businesses without any friction whatsoever, with just a basic smartphone, they might leapfrog a lot of ways in what the West is doing, and they're going to fall behind. And that's kind of what the internet allowed for, I guess. Anything that cuts out middlemen. And I guess that's my hope, because at the moment, it definitely looks like they really want to clamp down on it and basically make it like Coinbase is becoming a bank, Binance is becoming a bank.
Yeah. I mean, look, and I think we can talk a bit later if you want about the comment that I made at that Gold and Alternative Investments conference, which, people sort of, I didn't get a lot of time to talk about it, but I did say that, gold and Bitcoin are similar, but in my view are not necessarily a good form of money from a society point of view, but they have a function and a role. And the issue is, I think, the banking system, not so much the money itself. So it's something we can discuss if you want. It was a bit of a controversy. I think a lot of people looked at me and went, what's he saying?
Yeah, so maybe we should go a step back before we do get into that conversation about what drew you to gold and silver, because you've been talking about cryptography and privacy. Was it the sound money, the scarcity and the finite? Because we really didn't have all this QE and central banking is becoming celebrities until the GFC, and you've been doing this since the early 90s. So back then, was it just worries that, we've gone off a gold standard a few decades ago and this stuff might happen in the future, or what was the thought process back then?
Well, look, I mean, I'll tell you what, I had a trouble getting a job out of uni. It was a recession. I got a job as an assistant store manager in the reject shop. And then this job came up to administration officer at the Perth Mint in Sydney. They had a Sydney outlet.
Yep.
I had no idea about gold. It was just a job. And so I turned up and, this is an interesting job. There's all this shiny gold and there's a lot of people paying cash over the counter, and I'd have to count up the cash at the end of the day. So I had no idea about gold, and it's something that I just got into, as you progress in the career, you sort of start reading, and it was very early internet days there with things like Kitco and a lot of early blogs that were talking about gold, and that's when I started to get a little bit more into what is gold and what's it about, personally, rather than just, this is some job that I do. But at that time, in the early 90s, gold was very, very unloved.
Yes.
And the buyers there, I suppose, were hardcore buyers, and maybe sort of the smartest sort of high net wealth people that were just going, look, a rich person always has a bit of gold on, in reserve as a safety thing.
Yeah.
So it really wasn't until, and even when, we know now retrospectively that gold bottomed in 99.
Yes.
At the beginning, right, at the turn of the century. So, but it still was a very bearish market. It was only until gold got above 400, which was a level that it had was unable to break during the 90s. That was when I think it started to pick up a little bit more attention and momentum, and then started to really develop into a proper sort of bull market. So it was a really tough market then, and there were a lot of sort of conspiracy theories. And interestingly, I was reading all this stuff and going, oh, wow, really, because I was still quite junior and low down, in precious metals as an expert. But then when I moved to Perth and started to get a lot more involved in detailed operational stuff and mechanics and how the actual business operated and how it operated internationally, I sort of started to realise, because I was reading things and going, wait a minute, that doesn't make any sense at all. If you know how the real physical market works.
Yeah.
So I realised that a lot of stuff on gold was actually not totally fake and conspiracy, but also just a lot of misunderstandings, not just about the mechanics of the market, but about the nature of gold and the purpose of it.
Yeah.
And a lot of it is then and is now clickbait driven. I want to get that person to press the button, to come to my shop. And so it does tend to result in a lot of rubbish going out there, and that can confuse people about, what's the point of gold? And then in related, what's the point of a cryptocurrency? Because they're very similar.
100%. And that's something that I tell people all the time. When I went down the rabbit hole after the GFC, I was about 21 and third year uni, and you naturally find a lot of the conspiracy. YouTube suggests them to you. And after a few years of people saying that silver's going to go to $600, you soon realise that it's not, and you start to find out how the world really works. And I do want to get into your thoughts on rehypothecation and fractional reserves, ETFs later on. But I guess, what was the environment like in the 90s when gold wasn't loved? Interest rates are very high. It's I guess similar to what people thought last year, that interest rates were going to start to rise again and gold was becoming unloved. And do you think that situation's changing now with interest rates lower for longer, making gold more attractive?
Look, certainly interest rates are one of the big factors in gold. It's like an opportunity cost. If you can earn 10% in a bank account doing nothing, then gold's not looking too attractive. As soon as interest rates get down to zero, or they start to get close to inflation, then gold becomes attractive. And that's one of the big macroeconomic drivers for the gold price. And look, a lot of that was in play in the 90s. It was really, really hard because I moved to Perth in 98 and we were setting up the depository business then. And I got to tell you, it was really hard to get anyone interested, get any distributors to resell gold. It was just no interest at all. Now, we're not seeing that situation now. I think the difference we have now is, and the reason gold struggled quite a bit over the last 6 or 7 years is because there are a lot of buyers that had bought into the hype right at the peak.
Yes.
And, they were still sitting on gold and they were sort of seen it drop. And so every time gold sort of went to 1,100 or 1,200, those buyers, those old or stale longs as they called them, were like, I'm out. Right, so then they would sell into whatever spike that was. And then there might be another bunch that were waiting and 1,250 was their limit and they're like, I'm out.
Yeah.
So the market's sort of been kept sort of dragged down because I think all of these old stale longs have been just sort of offloading into the market. And what's interesting about gold breaking out of and up to 1,400 and 1,500 is that I think it's shown that selling those old longs are out now. And so that weight on the market has disappeared. And now we've got, and obviously there's new buyers coming in. I think it's mostly smart money, hedge funds and other sophisticated institutional and private investors that see all the stuff going on economically and going, we haven't solved the underlying problems from the financial crisis.
Yes.
So they're going, you know what, I'm going to start positioning into gold. We're not seeing huge retail interest at this point. So it's still early stages in my mind. And that's why I think it's being held up and supported at this point.
See, that's interesting for me because when we had that run and there was the clear breakout from that level, as you say, it was a lot of similarities to the crypto market. I was getting so many messages from people, how do I buy gold? And that was when it was 1,500. And I was sort of saying to people, did you learn the lessons of crypto when it goes parabolic? It's not the time to be buying. And now we're having a pullback. And I'm not sure how much of a technical analyst you are, but I think this is healthy. And I'd love for us to maybe retrace and bounce off that level that we've broken through. But I did notice a lot of retail. But do you think that when Bitcoin has that parabola, that there's a lot of lessons to be taken from that when Bitcoin resumes its market, there's going to be those stale longs that we just spoke about?
Look, I think that's a factor in all markets, and I have to say, there's a classic chart of a bubble. I don't know if you've seen this Hofstadter chart of the stages of a bubble, right? Yeah. And I did a presentation a number of years ago, and I overlaid that, and you would be surprised how many markets, and I'm just talking commodity markets, stock markets, exhibit this exact same bubble behaviour, which is a sort of initial surge, a correction, then the parabolic move. And then the key is that it drops down a bit. People go, oh, buy the dip, goes up, and then it has the big final crash. Yes. And that pattern, I'll send you the PowerPoint.
Oh, trust me, the crypto community.
Maybe you can overlay it over while I'm talking now. Yeah. You'll be blown away by how many markets exhibit that behavior, because this is just pure human psychology, right?
100%.
And so I think that Bitcoin is no different to any of these other markets, and it's a huge lesson to look at that shape and become aware of it. And interestingly, I was talking to a guy who in the US used to trade, who's an arbitrage trader, and he said to me that from his point of view, he considered gold like one of the perfect sort of tech markets to trade based on technical analysis, because it was very sentiment driven. And in that sense, it's like Bitcoin because the fundamentals, there isn't like a stock price and it hasn't got like, makes cars and you can work out the gross margin and, all of those sorts of like fundamental factors. There are fundamentals obviously in the gold market, but the huge sentiment aspect to it is what drives that psychology, that human behavior, and drives those technical behaviors. So I think people in crypto and gold really do need to pay attention to that, as well as sort of underlying type fundamentals, which, I noticed there even is in crypto. I was at a University of Western Australia crypto conference early this year, and there were a lot of academic papers that were trying to establish, what's the fundamentals of mining costs, and all of that to try and work out some fundamental parts of that drive the crypto market. But there is obviously this huge speculative and human emotion overlay on top of that.
I couldn't agree more. And I was just going to say that I think every crypto investor is actually aware of the Wall Street cheat sheet, that pattern, because it is just so prominent in the crypto space. And basically, the bad coins never recover. They trickle down to zero, and the good coins tend to have a leg up generally by a factor of 10. If they're improving and developing and the market cap's growing, we tend to add another zero every year or two. So that's definitely what I think is still in play for Bitcoin if we continue to grow. But do you have any thoughts on that?
Look, it's hard to know with Bitcoin because it is still quite early. I mean, 10 years is early, right, in terms of a brand new asset class from nothing. So it's really hard to understand at this point. And that's why I saw in those academic papers there's a lot still of debate and uncertainty around, well, how do you determine a fundamental value?
Yeah.
So I think it's really difficult to make a call on it. And I think that ultimately its similarity to gold is I think going to come, its fundamental value is going to come from the fact that it is that sort of safe haven go-to asset. If you want to get out of the financial system, if you're worried about the banking system and the quality of its assets, where do you go to? Now, gold has that history, right? It has that brand recognition as being the asset to go to if there's a financial crisis. And I think it's probably going to hold that for some time. The interesting question will be is whether cryptocurrencies, and I suppose Bitcoin particularly because it has that first mover and sort of key position, is whether that will be the go-to asset for millennials and younger generations. So then as they mature and get into the 40s and 50s and start having a whole heap of money, and if they're looking for a safe haven asset, are they going to say, hey, you know what, I'm used to and I understand and know about gold because it's now been 20 or 30 years worth, cryptos for 20 or 30 years worth of trading of it. You know, my preference will be to sort of, if I want to look for protection, I'm going to go to that asset versus gold.
Yeah.
That's an open question. I mean, you know, I don't know. We don't know the answer to that. Gold's got a big history. And it may be that both of them work together. People put a bit into both. But obviously right now, the current sort of baby boomers still have very much see gold as that go-to asset in crisis.
Couldn't agree more.
So I think Bitcoin's still trying to establish that. So it's an interesting question.
I think my base case scenario for the bullish conditions for Bitcoin and gold would be we get back to that scenario. Bonds and yields are having a bounce at the moment, and we got to 17 trillion of negative. If that number gets to 20, 30, 40, 50, I think it's very, very bullish for gold. And I think Bitcoin is going to follow suit again. But the other angle that Bitcoin has that gold maybe doesn't is all these developing nations. And I think there's 100 currencies and all these Southeast Asian currencies with market caps in the tens or hundreds of billions of dollars. And if all of them start having poor monetary policy, like we're seeing, and the US dollar continues to get stronger and stronger, then all these, well, they're millennials, but they're the biggest demographic and age group in a lot of these countries. And if they've all got a smartphone and they can press a button to sit in Bitcoin rather than Venezuelan, Chile, you know, all these other currencies that are just going to become worthless, that's where I think Bitcoin can just death by 1,000 cuts of all this fiat currency going into it. Would you agree with that? Or?
Well, look, I think that's, as I said, you know, how a younger consumer will develop once they start to build wealth and what they want to save in is a question. Venezuela, look, the thing about a lot of those countries is that there's a very big cultural awareness and appreciation for gold. So I think Bitcoin's still going to be competing.
Yep.
How strong that sort of cultural thing will pass down a generation and whether it will hold on is not so sure, because I think some reports that I've seen done on the Chinese market is that a lot of the younger consumers there, have different sort of purchasing behaviour to their parents. They're still, okay with gold, but they are looking at different sort of assets and also just on consumer goods as well. They want to spend their money on the latest phone, not on buying a gold coin. So
yes,
it is an open question, and how much the cultural affinity for gold will weigh against a crypto appeal of crypto, I'm not sure. And certainly there's a lot of players in the gold market that are trying to make gold as easy as just, popping on the phone and buying it. And obviously all of the gold stable coins are an attempt to sort of try and be, in that space. I mean, it's an open question, I think, and at this stage, the gold cryptos, stablecoins haven't really shown any traction. I think there's reasons for that. So, it's going to be a very interesting time in the next 10 years, I think.
For sure. And I definitely agree that is a huge advantage that cryptos had, the fact that they're digital and someone can just push that button. But now stablecoins and gold are becoming digital as well. That's very interesting. And I don't even think it's about storing the wealth as they accumulate it. Some people that might earn $10 a month, if they know that might be worth $8 or $7 in their local currency, they're probably going to take the risk that Bitcoin is hopefully going to be trending up in a bull market. But I mean, all these things remain to be seen. So next up, I wanted to talk about manipulation. So we already touched on the fact that there's all the conspiracy theories out there and whatnot. But when the ETFs came out, the gold had a terrific run, and maybe that created some awareness and some good sentiment. What are your thoughts on all this? Is it bad that we have dollars that are chasing exposure to an asset that are going into things that are not backed and cash settled and aren't putting any real demand for physical gold? And do you think that's a big threat for Bitcoin as well?
Look, it's a bit of a sort of a philosophical question. Look, let's put it this way. I mean, the way that I look at it is the comment, particularly say futures markets are the classic example of a paper market. Okay. Yeah. And people go, look, there's all this trading in there, and there's only 1% or 2% of it has got gold sitting in the COMEX warehouse vault. Yes. But the thing is that whilst the shorts on the short side of those contracts don't have any gold, the thing is that the buyers, the long holders, they don't have any money either. Yeah. Because they're all trading it on margin, right? So they're putting down 10% or 5%, whatever the requirement margin is from the broker and the exchange, because they want the leverage, right? And I think obviously people in crypto should understand that, because people want, the big gains, right? They want the 10-bagger. And that's what a lot of people that are playing in these paper gold markets are doing, is that they're trading on leverage. And so they're never going to, they don't have, like if they have $100,000, they can buy $100,000 worth of gold, or they can put 100,000 margin and have $1 million, control of $1 million worth of gold in a futures contract, right, simplistically. So it's not like the value of those futures contracts are potential cash that suddenly all those people could find the money and buy the gold. They just don't have the money. So the question becomes philosophically, is that really gold demand? Is it real actual demand? Are they actual physical buyers? Or are they just gamblers who are betting? And so, I'm not so sure that they do. The thing about it to keep in mind is that if there's a long or a short who are both paper, right, and they've both got margin in, then effectively they net out to zero in terms of their impact on the actual underlying market.
Yes.
But in these markets, there is ultimately a link back to the physical, okay? So if you consider, say, a simplistic scenario that there's a futures market that starts from scratch, and someone comes in who wants to go long and says, I want to buy a contract, but there's no one that wants to go short. Now, what happens in that situation is that usually a trading firm or a bullion bank can step in and say, yeah, that's fine. They would do an arbitrage transaction, which is what they do, is they say, I'll take the short side, no problem. And they hedge themselves by going, fine, I've got a short contract. What I will do is borrow cash and buy physical gold. So they are long physical gold on one side and they're short a paper contract on the exchange. Their net exposure is zero. It doesn't matter to them if the gold price goes up or down. And the price that they charge, because obviously the cost of borrowing money and storing the gold is a cost to that, and that's why a futures price generally is higher than the spot price, because the bank's sitting there saying, I had to borrow money and I had to buy gold, and I'm going to hold this futures contract for 6 months. So effectively, the futures price factors in that holding cost, the carry cost they call it, for a market maker to take a short side and hedge themselves. So in that sense, if you think of that simple example, a person who bought a long contract, a futures contract, by the market maker going short and then buying physical gold, the long buyer has actually impacted the physical market.
Okay. Yeah.
Right. It has actually caused the physical gold price to go up. So the question is, in a futures market, how much of the longs are backed by just pure paper shorts, other gamblers? Because those two sort of net out, and how much of that actual long position, how much of it is actually a hedging, an arbitrage firm who actually went out and bought physical? Because it's that part that actually starts to affect the physical market.
Yep.
And the question is that, in a sense, what is behind a lot of the conspiracy theories is a debate, because there's no hard facts. We don't know exactly what bullion banks are doing. We don't know what arbitrage traders and hedge funds and others do. Is how much of that is actually just completely paper unbacked by a gambling firm who's put up margin, and how much is actually being hedged into the physical market. And so that's the debate. If a lot of the stuff is physically backed by hedges, then you can say that the markets aren't as manipulated. If they're just taking short contracts, if an arbitrage firm or hedge fund's taking a short contract, explicit exposure, then there is potential risk that they might fail. And in some sense, you could consider the market manipulated or unreal. It's just that a lot of the conspiracy theories are very adamant that they know for a fact that it's all unbacked, sort of behaviour. We don't have the facts. That obviously it's a private, sort of confidential, over-the-counter market.
Yeah.
We do not know exactly what the nature of the various large bullion bank sort of activities in the market are, which allows for speculation, right, as to what the underlying exposure and risk is and reality of the market.
So in crypto, we hear things like, oh, there's way more shorts than longs. And we just spoke about that. And we've heard the other day, oh, there's a record amount of silver shorts. So as you say, there's always a long for every short. But do they derive those statistics from, is it the maker versus the taker? So who's borrowed off the broker to take that position? Are you familiar with how they get those longs versus shorts statistics in the futures?
Oh, look, no, from COMEX and other web exchanges, they're just summing up the total contracts as people buy and sell and they're matched to a longs matched to a short or vice versa. They're just looking at the total volume. Yes, there are sort of significant trader reports. So COMEX does have to say, of the largest banks, how much positions they're holding for the house and how much they're holding for clients.
Yes.
But it doesn't really even then tell you what their underlying position, because a bullion bank could be for their own account, short, but they could be holding a large amount of physical, because you've got to look at a bullion bank, what their business is sitting in between a lot of different players. So, for example, a mining company, often, they don't do a lot of it now, but mining companies do actually forward sell, right? So to a bank, if a bank says, okay, I'll buy this gold off you in 6 months' time and I'll agree the price now so that the mining company knows that it's going to have a guaranteed revenue, that mining company is now basically long gold because they've got a commitment to buy it. So they could hedge that by going short in the futures market. So in some sense, some part of their short position in the futures market could be backed by an obligation by a mining company to deliver gold to them in 6 months. Now, it's not physically backed, but they are backed by some gold that will flow in 6 months' time.
Yeah.
Right? So in that sense, you would say that bullion bank doesn't have a price exposure. They're not outright short. And so if the gold price drops massively or goes up massively, they don't actually make huge amounts or lose huge amounts of money.
Yeah.
The question, though, and this gets to your talk about fractional and what banks do get engaged in, this is normal banks for cash, but the situation I've just described is a situation where it's a liquidity or timing issue. Because if a mining company, if a bullion bank, say, is contracted with a mining company for 6 months and another one for 9 months, and they've got also, say, a jewelry firm who says, I want to buy gold in advance and lock my price in, and that's done for 12 months, and then they've got futures contracts, which might be for 1 month and 6 months and 12 months. What you've got if you look at the bullion bank's sort of long positions and short positions, is you've got a mismatch in timing. So some gold might be coming in from the mining company in 6 months, but they've got other short contracts which are requiring them to pay out in 3 months. And so this thing, which is called maturity transformation, is no different to what banks do, right? borrow money, you have a deposit accounts where all the money's on call, right? I could walk to the bank and say, give me cash. And what's backing that? Well, it's a 30-year mortgage to someone who's bought a house, right? So there's a mismatch between these mortgage loans, which are going to get paid back over 30 years, and all these cash deposits, which are on call. And that mismatch in timing, liquidity, is occurring in the gold market. So there's not just a case of, well, how much of the positions in the market are outright short, purely exposed to price, and how much of it is actually timing mismatches and liquidity problems where, geez, I've got to pay out gold, but I haven't got any coming in from the mine yet, and I've got to sort of quickly borrow some gold to make up that gap. And that's sort of very similar dynamics that can play in the gold market to play in the cash markets. So it's really hard to get a handle on that because all of that trading is very much over the counter and unsurprisingly private, right? Because neither you or I want anyone to know how much gold we've got, and neither do big sophisticated investors want anyone to know how much gold and what they're doing with it. So it's hard to get behind that.
So when we read things like, 2 billion paper ounces of silver have been dumped at 3 a.m. at, market price, and that's definitely not the best way to execute an order. You don't really think that there's a bit of a cooperation of some of the banks and, the theories about trying to make the dollar look stronger. You think it's just all part of what we just described, fairly normal activity?
Well, that's a bit different, right? And it's an interesting question because my answer to that would be, and you're right, I mean, you don't want to dump that much in a large go. But if you're wanting to make an impact on the price because you've got some other sorts of contracts, right, it may not be necessarily government manipulation. It could purely be trader gaming, right? And look, a lot of, so something like that where someone says, you know what, I've got an opposing position, but I'll go and dump a whole heap in because I want to make a price impact and I want the price to move in my direction because I'll make a profit on some other contract that I'm holding. It can be that a hedge fund who might have a position in gold will sit there and go, I've got positions in bonds and stocks and they're moving in this way, which is counteracting what I think is going to happen in the gold market, and I've got to readjust into these markets, and I've got to use the money I want to get out of gold and get into those markets. Now, yeah, if they dump that amount in gold, they're probably not going to get as good a price as if they fed it in slowly. But from their calculations, they might say, you know what, I don't care if I'm giving up $5 an ounce or $10 an ounce, because if I wait on that gold sale, I'm going to miss out on the move on another asset class that I'm hedging, right, or trading. So to them, they go, stuff it, who cares? Dump the gold because I need the money quickly because I want to make a profit somewhere else. So it's not necessarily uneconomic because you don't really know why they're selling it and for what purpose.
Yeah.
So is it traders' games where they're trying to, sort of bluff the market, or is it actually, some sort of other trade side to the trade that they want to sort of make a profit on, which so it doesn't matter. I mean, I don't know, we don't know. But that's what allows for great speculation, right, for these interesting articles to come out. So,
and I guess final question, because I don't want to move on from manipulation, but we have actually seen in recent years a number of banks get charged with price rigging and whatnot. So, is the extent of that as bad as it's made out, or do you think that's just people playing around the fringes of opening and closing prices and things like that?
Look, from what I've read of all the transcripts, and I've followed a number of these cases for years, at this stage, all that the regulators seem to be going after are these spoofing trades. And in a lot of cases, they're spoofing up and down, and they might be spoofing it, they might be impacting on cents or a dollar. It's manipulative behaviour and it's illegal behaviour, but it's not the sort of stuff that proves, and I think even Gator has sort of admitted this, it's not a stuff that proves a long-term suppression conspiracy because it's just not significant. These are trader games that traders have been playing. And, it's interesting because I think that if you look at the logs, I think back in the early 80s and 90s, this sort of stuff was not considered illegal and was considered part of big players defending themselves against other players like algorithmic traders and all of that, right? And so that's why when you read the Trat logs, these guys talk like that, because they grew up in an environment where, you had to bluff to be able to not get screwed over. And there's you got to think about, I mean, in some sense, what they're doing is no different to say, when you go down and buy a car, right? You don't tell the car dealer that, you really, really want this car. You go, oh, my wife, she doesn't like this part of it. Or you say, oh, the Toyota down the road is, I'm really interested in that. I mean, you're bluffing, right? You're telling a fib because you want to get the best price. And then he's crapping to you about, I don't have many cars in the lot. There's a whole big shipload coming in the next day. I mean, that's lying, that's dishonest. In some sense, that's sort of what these traders were doing. Now, I think they've gotten caught out because the rules have tightened up, the regulations have tightened up, and some of this stuff is really unfair, particularly if they're trading on behalf of their clients. They're supposed to act in the best interest of their clients. So I think a lot of these guys have been caught out because they're just like, oh yeah, that's what we always used to do, and not really going, wait a minute, rules have changed, we can't do this stuff anymore. So it is manipulative. It does give you an indication and a question to say, well, what other things have they done if they don't have the ethics around that? And so what I'm waiting for is a really meaty case to come out, not just, I spoofs the price, a few bucks or something. I mean, maybe that's what the CFTC and the SEC and others will get to eventually, is this is the start. And then as they get more discovery of information, we may start to see a lot more come out around other activities.
Yeah. And with all that happening, it's sort of it's part and parcel in the crypto space at the moment, and that's why we haven't had any ETFs approved. So do you think that Bitcoin can ever really work on Wall Street? And because the 24/7 nature and the weekend trading, if we have a huge move and people were trading on leverage, that would break the gold markets and all the derivatives. And we saw a volatility ETF blow up at the start of the year when we had a 10 or 20% move. So to me, I kind of think that they can never really tame Bitcoin, or can't really ever trade properly on Wall Street, and there's not ever going to be enough regulation because you can't ever regulate every country where it's traded. So do you think that Bitcoin could never get an ETF? Or
yeah, look, I mean, it's interesting how many ETFs have put up and how much times they've been knocked back. You think, why do they keep trying? They understand what the underlying issue is. But look, there's something to what you say. And yeah, I think it's a challenge, because the interesting thing about Bitcoin is that, unlike most markets, it's similar to gold, and gold's a totally global market, being a mixture of exchange trading and OTC trading, that you can't control, right? Regulators are used to saying, hey, we control the American Stock Exchange. These are our rules. You've got to do this. And yeah, they can enforce it, and they can observe, and they can watch and all of that, and they can analyse to see if there was someone doing, illegal transactions and front running and whatever else they want to do. But when you've got a global market across multiple exchanges, as you say, 24 hours a day, it's going to be quite a challenge. And in that sense, Bitcoin really is that libertarian free market where anything goes. And now it makes it tougher, right? That market is a market in which you're seeing these real sort of manipulative, pump and dumpy. You've just got to go, hey, that's the nature of the market, and you just got to be smart about it when you play in that space, and understand and not go in naively, because it is a completely wild west.
Yeah.
Now, whether it sort of comes down to, what happened in a lot of cases is that in other financial markets in 200-300 years ago, is that the main players did get together and put self-regulation in place, because they realised that whilst that was fun and it allowed for a lot of trading profit, if they really wanted to grow and become substantial, they needed to weed out some of that stuff, because you don't want to really screw over mums and dads who are probably not as smart about it, okay? And so you won't get mainstream adoption if you don't make it safer for mums and dads. Now, I can see some libertarians going, hey, so what? If you can't stand the heat, don't get in the kitchen.
Yeah.
Hey, and that's the debate that crypto's sort of got to have. And I think it's a debate, that between sort of becoming mainstream and regulated and proper, and hey, let's just stay Wild West and unregulated. That's obviously a real big philosophical debate that still goes, right? So, yeah.
And I think the volatility debate, maybe it isn't really legitimate in my mind. I mean, I'm sure you've seen plenty of silver stocks and gold stocks and junior stocks, move 30% in a day or more, 1,000% in a year. So again, I don't really think the volatility argument is a good one for not having Bitcoin and crypto products.
Yeah.
You agree with that?
Yeah, look, I think a Look, I think the regulators here are maybe putting a bit of double standard, but obviously they are concerned around the volatility and seem to be authorising a product that, has the potential. Then again, they authorise 3 times leverage ETFs. So, yeah, you're right. I mean, are they really, what's the ultimate issue that they've got here? Hard to know what the real underlying problem that they've got when they allow a lot of leverage in other markets.
Yeah. So let's move on and talk about physical gold and silver, because we do see everything happening these days. Trade wars, currency wars. China and Russia are stockpiling. Germany's buying again. A lot of other countries are buying real gold, and central banks, there's these clips on YouTube about why do you hold real gold? Oh, it's just tradition. Well, there's already talk of if the system resets and the system's not working anymore, maybe we'll have to back it off gold. So I don't really think you can go back to a gold standard these days because we've gone way too far. What do you think is going on at the moment in the physical gold market with central banks buying and whatnot?
Yeah, look, central banks are a very interesting case in that they obviously hold a lot of gold, but not too many of them want to talk about it. Yeah. And so, because it does raise the question, well, as to what backs the currency and what's the strength of the currency, and why are you holding it if you have total, if the central bank has total confidence in the currency of the country. And so you see this sort of ridiculous situation when, particularly in the Federal Reserve, where you mentioned it about, we hold it because of tradition. I mean, what a ridiculous answer to a question, Yeah. And I think you're probably referring to, I think it might have been Ron Paul interview of Ben Bernanke or something along those lines.
Yes.
And it's really frustrating because I was sitting there going, why doesn't he just follow up and go, well, because the logical thing to that is if you're just holding it because of tradition, like that's sort of irrational and you're supposed to be this super rational technocratic central bank. Well, either you're a complete idiot and, emotionally driven, in which case, why are you running the interest rates in the economy, or you're lying. And I would have asked that question and say, look, you've got a choice. You can either stick to tradition, and we should say, listen, you're pretty incompetent if you're buying stuff for that silly reason. The reality is that central banks understand that ultimately, if there is dislocation like a world war, you want to buy a warplane or, food and import food, the other country is going to only take gold. And so ultimately that's why they hold it. They don't want to say it so explicitly. They talk about it, backing and safety and a safe haven, but those are all sort of code words for an asset of last resort. Yeah. So I think it's interesting that since the financial crisis, central bank holdings have started to grow. They were declining for numbers and numbers of years, and they're now starting to grow. And it was originally China and Russia, which are probably looking at it for geopolitical reasons. But now when you start seeing Poland and, a few other countries sort of adding to the list of people that are buying, and then you see repatriation moves, which, may have some populist element to it, but you also have to think that the central banks are sitting there thinking, we want to have the gold close to home. It does speak to concerns about, the financial system, and I think concerns about how much longer they can sort of paper over the underlying sort of problems that the financial crisis revealed. So I think it's a lesson. Investors need to look at that and go, if central banks are concerned, I should probably be concerned.
Yeah. And how much of a canary in the coal mine do you think it is that the US hasn't had that big public audit of Fort Knox for decades? I think it is. And we recently, I think it was a couple of years ago, someone went in there and said, yeah, it's all there. And they said, do you have any photos or evidence? And they said, no, just trust me, there's 7,500 tons there. This is the stuff that I think makes people angry. And you talk about the populist movement and whatnot. There's just no truth and transparency in government and things like Fort Knox.
Yeah, look, the Fort Knox issue, they do have what they call a Government Accountability Office audit. So they are actually audited, right? The thing that there is no audits is not really true. However, there are questions around the audits that Jan who used to write under Coos Janssen, but now writes for Vioma Gold. He's covered that extensively and has put in a number of FOI requests. And there are issues around how they run those audits. It is, in the case of the US, it's logistically quite difficult, to be honest, because it's a substantial amount of gold.
Yeah.
And that gold, I'll tell you, it just takes time. I've done physical stock takes. It takes a really long time to count.
Yeah.
And you'll see that something like the ETF, some of the big ETFs which do audits by independent firms, it's days and days that takes them to count that stuff. But there is a valid issue, I think, to a lot more transparency around that sort of stuff, because those assets are assets of the country. Australia's gold audits that it's done have been pretty substandard, I'd say. The fact that they aren't willing to, or the Bank of England's not willing to give them a serialised bar list, and that they just sort of, take samples and not sort of, it's quite structured and controlled in terms of the access that the RBA has to its gold in London at the Bank of England. So it is there can be improvements quite a lot in that. I'm not a huge believer that the physical gold does not exist. I'm pretty sure the central banks have it. However, there is rubberiness in the standards around reporting of central bank gold. A lot of central banks just list gold, and they do not split down between physical gold and gold that they lease out.
That was the next question.
Australia, RBA is actually quite transparent about that, and it does split out its leasing to its physical gold holdings, but a lot of central banks do not do that. And so there's a valid question to say how much of that gold is physically there and therefore a real safe haven, and how much is financialised and being lent out is therefore at exposure to the solvency of a bullion bank.
And do you think that is something that that breaks the paper system one day if there's ever the huge real demand, and there's the leasing, as you say, and there's 2 or 3 claims on every bar, or there's never going to be everyone calling their gold at once?
Look, the interesting thing, as I sort of pointed out, the nature of a bullion bank is banking, right? Which is they borrow and they lend. And so when the question is, if they've borrowed an asset from a central bank, they borrow 2 tons of gold from a central bank, the question is, how are they using that? And what terms are they lent it out at? Because it's that mismatch of timing, it's that liquidity question that is what will cause a problem in the gold system, in the overall gold bullion banking system. I don't think it's so much around a price exposure. Now, this is just my feeling. I don't have anything to back it up. But I don't think banks take massive proprietary outright exposures, either long or short, to the gold price. Yeah, they have traders and they have a trading desk and they probably do have trading positions, but I don't think it's to the limit that it would break the bank. The issue is more around, well, what's the nature of their assets and liabilities and how are they matched? And is there a risk that people who hold particularly unallocated gold say, hey, actually, I want to take delivery? It's when does that actually put a squeeze in the physical markets? Yeah. And you see that squeeze is expressed not so much in price, but in the lease rate, the interest rate on gold. And there has been periods in the past where the lease rate has spiked massive amounts, 5 times, 10 times its normal rate, which, would be crazy in the cash market. But it does give you some sense about the potential for a liquidity squeeze. Now, whether a liquidity squeeze turns into a sort of a solvency problem and a bankruptcy issue because they simply can't meet the obligations, again, that's a really hard thing to make a call on. But that's the real risk, I think, more so than price exposure.
Yeah, the next thing I wanted to talk about was silver and the gold to silver ratio. I know you've done a lot of work on this, and I think traditionally, we hear this number around when it gets to 80 or 90, generally reverses, and we see those nice charts that show this. Do you think that the maybe monetary value of silver, that use case is maybe becoming a little bit weaker? And is it the industrial use that's going to start a new bull market? Do you think we could get to that 100 to 1 and past that ratio? Has silver lost its shine to you, or is it going to catch up when gold really takes off?
Look, I do think there's still validity in looking at the ratio, and I do think that silver has different dynamics because it is half its demand is industrial, right? Whereas gold's probably 10% industrial. So there's very different dynamics driving it. And I think that will drive a change in the ratio ultimately. So you will still see a chance, I think, for the ratio to drop and silver to outperform gold. I don't think that silver, will get down to these 15-to-1 historical ratios. I think that's just changed. The dynamics in the market have changed. And there is a risk that silver could move up from 85 where it is now to 100. It has done so in the past. But I think that, there's a balance of probabilities is that the ratio has got room to weaken and for silver to outperform. In the long run, it is an interesting question as to, again, the digitisation of assets. I mean, one of the reasons behind silver's sort of demand was that it was poor man's gold, right? Which meant that if you had, only $100 or $200, you couldn't buy an ounce of gold, but you could buy silver. Now, in the 80s, when the only way to buy gold was literally coins, that made sense. And maybe that underpinned a relative value for silver. So I think it's a question in the long run to think as we talk about millennials and younger investors coming through and they're used to trading a phone app and buying gold in digitized amounts. Hey, you know what? I mean, it doesn't matter if gold's $2,000 an ounce and silver's $20 an ounce. It's just decimal fractions, right, of a balance. So in that case, you've got to sort of say, well, does silver have any... There's no poor man's aspect to silver in that sense. And so maybe its relative demand will weaken.
Yeah.
I don't know. This is sort of, again, part of that shift into digitisation and the baby boomers moving off and younger investors coming through with different attitudes and different ways of thinking about and buying assets and that is a structural change in the market. I mean, one of the things that drove the silver ratio up so high in the 90s was actually the US had a strategic silver stockpile of, I think, 100 million ounces, and they were offloading that, over a number of years. So when you have structural changes in a market, the ratios and relative values change. And so I think millennials coming through and digitized assets, be it a stablecoin version of silver or gold versus just interest in cryptos versus other assets, that's a structural change in consumer thinking, and it's got to have an impact in relative asset values.
And do you think silver, that industrial demand, can grow by a factor of 10 when we have, the lower class in China and India? We've got billions and billions of devices and electronics. Can that cause a huge increase in demand for silver? Because as you say, long term, it's that 10 or 15-to-1 ratio that it comes out of the ground at. And we have things like the stock to flow ratio. I'm sure you've seen those charts with silver and gold and Bitcoin. Do you think silver could have a sharp uptick in industrial demand, or not really use that enough?
I don't think so. I think silver's upside has been touted as photovoltaic, right, on the solar panels.
Yeah.
But what happens, and you see this in platinum and palladium in use in catalytic converters, is when the price of something comes up, substitution and alternative technologies start to become more, better. And I have heard of, non-silver sort of based solar panels, and so it's even hard then to say, is silver going to have a huge market there? I think it's going to be supported, and I think the industrial uses will still be quite a strong component. I don't know if in the long run that's going to be enough to overcome maybe any drop-off in silver investment. But for the moment, silver still has an understanding. People understand that silver is like a leveraged version of gold. So when gold moves, there is this sort of, again, human behaviour, knee-jerk reaction to say, well, I better get some silver because that's going to go up more. And whilst that's sort of like a self-fulfilling prophecy, then silver will still perform, right? So,
course, yeah.
So it's...
these are longer-term themes I'm talking about. I still very much like gold and silver, and particularly when we have another big crypto bull market, being able to take profits into digital gold and silver, or even real gold and silver. A lot of these bullion firms now will accept crypto. Is very interesting to me.
Yeah.
I guess finally, just to wrap it up, I want to talk about what are the biggest drivers for gold in your mind? It may be Bitcoin as well, silver as well, but is it the macro policy? Do you think that fiat monetary system or the debt is beginning to crack and the unfunded liabilities, there's no way out but to debase all the currencies? Or what's the best case scenario for gold?
Look, gold's ultimately, its main price moves are driven by investors. And what I saw through the financial crisis in 2008 and is what I would sort of call different levels of freak out. Okay. So what we would see is that the gold price there would be some sort of, announcement about Lehman Brothers or, some TARP program, some sort of new development. And these were constant sort of things over a number of years. Latest dramas, latest concerns about what's going on. And every time one of these concerns happened, we would see a surge in people buying gold. And then it would level off, be flat. And then there'd be some other news event about some other blow up in some bank or whatever. And then there'd be another surge in gold investors opening accounts and buying. And what I realised is that if you look at the population as a spectrum, okay, over on this end you've got the really sort of optimistic people that, think the government's great and will look after them and everything's happy. And you've got the really pessimistic people who don't believe in anything and are cynical as hell, right? And there's a spectrum of that. And so what happens in the financial crisis was that every event was like a trigger point to another person on the spectrum. So for a person over here, they needed like 5 or 6 bad news stories to go, whoa, what's going on? I don't know if anyone's got under control here. Looking around, I better buy some gold, right? Whereas other people only needed 1 or 2 and going, hey, wait a minute, this looks, funny. Maybe they're a little bit more smarter about, financial markets. Maybe a little bit more plugged into alternative media. So they got the message a bit earlier.
Yeah.
They were buying a bit earlier. And I think what we will find going forward, because gold's now sort of based and it's formed a start of a bull market, is that as things unravel again, and I think there will be further dramas, because I don't think things were fixed. And this thing, pushing interest rates lower and lower and lower is just an example of how central banks aren't really fixing anything, they're just trying to paper over. I think we will get back into that dynamic. It might accelerate a lot more this time because the bull market in gold was a 10-year, 11-year one, right? It took a lot more particularly after the financial crisis. There was a number of years of stuff to trigger people to start buying gold.
Yeah.
I think this time people are going to go, hey, I knew there was a financial crisis, but I thought the government fixed it. Why are we having problems now? I think that's going to cause a lot more freak out and a lot more triggering of people to go, I need to protect myself.
I couldn't agree.
But expect it to be in that step surgy type of behaviour.
That's very interesting, and I couldn't agree more. Like watching what unfolded with the crypto space and how quickly and to the degree it took off was I think it was a symptom of Facebook, social media, interconnectedness. None of those things are really prominent, and there's whole people my age group now, 30 and below, 30 and over, that are all aware of the GFC. They saw their parents get hurt. A lot of people are on YouTube. They don't like the government, yellow vests around the world. I just think that spectrum that you spoke about, it's almost going to be like the majority now that are aware of what is wrong with money, with banking, government's debt and whatnot. So I think that's definitely going to be the catalyst for gold and Bitcoin. Yeah. And I actually think that QE4... they do not want to say that. They don't want to come out with those words and say that this is QE4. They're going to call it everything under the sun apart from that, because that is a real, that's ringing the bell and saying QE's back on, we didn't fix anything. So they want to avoid that headline, I think.
Yeah, and I've actually got a market report coming out today talking about the RBA governor's sort of speech that he gave earlier this week, which was all about QE and when are they going to do it and why they would do it.
Yeah.
There's a lot of interesting things there where it seems to me, because he ruled out negative interest rates in Australia. So we're never going to do that. Now, why did he rule it out? Because he knows that negative interest rates are a real flag. Well, they're a real trigger, okay? And so he's hoping that QE, because QE's point is, RBA plays at the short end of the interest rate money. They've been lowering those short end interest rates. And the point of QE is to get the longer term interest rates for government debt and company debt and push that down to sort of flatten interest rates out.
Yes.
And he's hoping that QE can do that and will solve whatever the problem is. And that he can avoid having to push into negative rates.
Yeah.
So they're aware that these things trigger people. And at the moment, I think for the average person in the street, and I think this is something that traders also need to be aware of, is that the average person is not as sophisticated, right? They do not follow financial blogs. They don't read all this stuff. They're just doing their job. They want to think everything's okay. And things like QE, it's all very technical. They don't really understand what that means. So it's only when, like, hey, you're going to get zero in your bank account, we're going to charge you now for cash in your bank. That's, and I think the RBA governor realises that the average person is going to get freaked out by something like that. So, but the fact that he's able to push it down and now talk about doing QE, I don't see any real way that he's addressing underlying issues. And so I think it's going to be inevitable. And I think once that point's reached, that's going to really just click people to switch. And I think that switch this time in this bull market will be a lot quicker because we've already been through a GFC and everyone remembers it. And it will be, hey, I thought you fixed the problem, Mr. RBA, Mr. Government.
Yeah.
You haven't. Okay, I can't trust you again on whatever program you're promising this time.
Fantastic. Well, I will put all the links to follow your work down below, Bron, but any final thoughts for people at home?
No, I just think that just be, as you say, you just got to be, crypto's a wild west, and then you just got to be aware of it. So if you're smart about that and you trade it, I think that's the main thing to be aware of. And in some sense, gold has that same sort of dynamic. So whatever lessons you learn in crypto trading, consider gold charts in the same eye. It obviously isn't as volatile, but it still has that human sort of emotional driver to it.
Absolutely. That's something we actually do talk about on the channel. So it's been a pleasure, Bron. I hope you guys have enjoyed this podcast at home, and thanks so much for joining us.
Thanks.
Cheers.